going to discuss about PEG ratio, that is price per earning to growth ratio. The PEG ratio, which is used to identify whether the stock's price is overvalued or undervalued based on both today's earnings and the expected growth rate for the company in the future. The PEG ratio is similar to PE ratio, but the PE ratio will not consider the growth rate when evaluating its value. The PEG ratio will consider the stock growth rate when evaluating its value. The PEG ratio is calculated based on the below formula, that is price to earning per share divided by earnings to growth rate. The PEG ratio provides useful information to compare companies and see which stock might be the better choice for an investor's needs. Now let's assume the following data for two hypothetical companies, that is stock A and stock B. Stock A price per share equals to $50, earnings per share for this year is $3, earnings per share for the last year is $2.5. Stock B price per share equals to $100, earnings per share for this year is $3, earnings per share for the last year is $2. Based on the below information, the following data can be calculated for both stock A and stock B. Stock A PE ratio equals to $50 divided by $3 equals to 16.5. Earnings growth rate equals to $3 divided by $2.5 minus 1 equals to 20%. PEG ratio equals to 16.5 divided by 20 equals to 0.83. Whereas stock B PE ratio equals to $100 divided by $3 equals to 33. Earnings growth rate equal to $3 divided by $2 minus 1 equals to 50%. PEG ratio equals to 33 divided by 50 equals to 0.66. Here, minus 1 represents the number of years used for growth rate calculation. Many investors may look at company A and find it more attractive since it has a lower PE ratio between the two companies. But compared to company B, it doesn't have a high enough growth rate to justify its PE ratio. Company B is trading at a discount to its growth rate, and investors purchasing it are paying less per unit of earnings growth. There are some drawbacks in using the PEG ratio, that is, number 1, PEG ratio makes assumption that may or may not be valid. Number 2, we cannot be sure exactly when a company's growth could slow down or speed up. Thank you for watching.